love the channel and find it useful in becoming a happy retiree. Subscribe today. The article that we've been talking about in Barron's that is about the lobby index and how it's done so much better than the general market over the last, call it, decade or so. If you look at when DC, the article that I published about this many months ago, the title of it is When DC Meets Wall Street, Capitalizing on Companies Working Well in Washington. So if you're at wesmoss.com, you could search for DC meets Wall. DC meets Wall Street. What Barron's will publish, and I'm very careful not to jump up and down about performance, but you look at how this is done relative to the general market since 2009. The general market, from the nadir of markets coming higher, finally bouncing, S&P 500 up about 300%. The lobby portfolio up 472%. 472% over that period of time. That is being an investor. And that is how we build wealth. I just tweeted about the article we've been talking about in Barron's. The title of it, Strategic Lobbying Index Yields Fat Returns. The reason I'm kind of jumping up and down about this is that I've been talking about this for 2.5 some years. I've had Dan Clifton, kind of the inventor of this, the proprietor, if you will, of this research and this strategy about how companies do well if they're really smart about Washington. And this is a portfolio that I've been invested in for some time now. It's 50 companies from the S&P 500. If you've got, I just tweeted this out. So if you're on Twitter, my Twitter handle is at WesMoss365. I think Twitter's sometimes kind of difficult to find people on. But if you're on Twitter, my Twitter handle is just WesMoss365, meaning that I'm Twittering 365 days a year. I guess that's why we did that. So WESMOSS. So it's just, Wes is just one S, WESMOSS 365. And the tweet that I just sent out, Barron's, this is not me, this is Barron's, just published an article that shows that the Strategic Lobbying Index, it's a group of 50 companies, it gets rebalanced every quarter from the S&P 500, is up 427.93% since 2/17/09. I mean, if you got money lying around doing nothing, why would you look at something like this? If you've got a bunch of underperforming stuff, maybe it's even in indexes that aren't all that good. I mean, there's thousands of them now. There are more indexes today than there are individual ETFs. There's been an explosion of indexes. And when you've got 5,000 or 6,000 or 7,000 different indexes to choose from, I know it gets almost to the point where people just throw their hands in the air and say, oh, what's the most common one? It's the S&P. Let's just put it in that. But don't let the swirl just stop you from opportunity. Don't let the swirl stop you from being a better investor. That's just lazy. It's just complacent. Nobody ever got anywhere being lazy or complacent. We're a show about opportunity. And I think that the reason I'm on that soapbox today is that so much of the world around us is not. So much of the world around us is about fear and how things are falling apart, and the trade issues are going to ruin the economy, and interest rates are going up, so it's going to crush economic growth, and the stock market's not a good place to be. That's just all fear talk. And it sells easily, by the way. That's why so much media is about fear about this and fear about that. That's why you see a fire on the evening news. It's easy to get people's attention. Oh, I don't want to be part of a fire. Let me watch and make sure I protect myself. That's human nature. What is not human nature is to necessarily dwell on opportunity and the positive. It's a lot easier to be running from something than creating something or building something. And investing is about building wealth over time. And the only way to do that is be an investor. Saving is one thing, and we've got to have the discipline to save, and that's the start of it. But the real power is putting that money to work for you, to compound over time. That's really been our theme today. And I kind of was reminded of that, even though I didn't plan on talking about any of this today on Money Matters. I wanted to. We'll talk next week more about what I had originally said we'd talk about. There's just such a powerful reminder, and I'm here to help you wake you up from that. There is opportunity, and don't let the clutter of negative and just the sheer volume of choice relegate you to a corner of doing nothing or getting 1 or 2% a year over time. It just doesn't build anything. It doesn't build any wealth. And I don't want you to be part of that camp. I want you to grow your assets. The book that you've heard me talk about forever, You Retire Sooner Than You Think, or You Can Retire Sooner Than You Think. It's all about getting to a place as quickly as possible so you do not have to work and your money is working for you. That's the whole point of it. I want to see you not have to work. Sure, if you want to work and you love it, and some folks do, yeah, listen to what Susie Orman says and work till you're 70, 75. That's fine if it's part of your life and part of your core pursuit. But I want you to have a life that is totally enriched, and that the money is a vehicle to do the pursuits, the core pursuits that you might have, as opposed to a commute that's an hour and a half every day in each direction that's draining you and that's just, quite frankly, killing you. I've seen it over and over again, and it makes me very uncomfortable to see people in that position. I hate it when I hear those stories, and I meet with folks almost every day of the week, and I hear that story a couple times every single week, and I have for so many years, about how, news, weather, traffic. Well, the traffic is effectively it's this oppressive, very unhealthy thing that so many of us have to just get through to have a job, and we want to be able to avoid that. Anyway, so that's the topic of today. So the key here, if you're on Twitter, you can find the article I just tweeted out. I've been writing about this for a long time. This is how this lobby portfolio, which is very much like the S&P, but has been a heck of a lot better over the last many, many years, to the tune of 472.93% since February of 2009. Pretty tremendous. And it's about opportunity, and it's about being smart. Don't let the abundance of choice paralyze you into doing nothing or settling for inferior investing. It's not how America was built, and I don't want to see you fall into that same trap. Let me talk about an example. I said I'd zoom in on some topics today. Procter & Gamble, it's a company that's gotten hit pretty hard over the last year. The Procter & Gambles of the world are not going away, and I'm going to talk more about why next weekend. But the reality here is that this is a stock that's still producing tremendous earnings. It's down about 20%. Still very profitable, but the stock price hasn't done all that well recently, and it's trading well below its long-term average of about 18.5 times earnings, but it yields almost 4% today. Consider this: since 1980, Procter & Gamble has yielded above 3.5%, and that's almost always been associated with the stock price falling, so that the yield rises above 3.5% because they haven't cut their dividend. So lower cost for the stock usually is a higher yield because the dividend stays the same. It's only happened about 20% of the time, but when it happens, and this is one of the phases that we're in today, the average rate of return for Procter & Gamble over the next 12 months, 28%. So when you see a company that's this strong in earnings get hit, the average rate of return over the next year is 28%. 12-month forward returns, when Procter & Gamble yields over 3.5, have been positive 96% of the time when you're buying Procter & Gamble with a yield above 3.5%. So again, markets always change, and this could be one of those, maybe it's different this time, different than history, but I doubt it. I doubt that this time is, quote, different for P&G. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.